the reason why the IMF had the balance sheet to be effective, when the issue was white people, there was a big appetite to increase its balance sheet. But the institutions that lend to brown people, call it the World Bank, the Inter-American Development Bank, the African Development Bank, they were not recapitalized.
Welcome, everyone. It's great to have you all join us today. And today's topic is going to be how to promote inclusive growth, especially in the era of COVID.
I'll start by saying the pandemic has caused, as we all know, all sorts of economic fallout around the world. The way macroeconomists usually capture the loss associated with the recession is that they look at economic activity that was expected to occur but didn't occur. So if you do that, for example, for the United States, you'll see that GDP in 2020 was about $1.5 trillion lower, or 6.5% lower than where our Congressional Budget Office thought it was going to be prior to the pandemic. And I choose the United States not only because I have the data handy, but I also think it puts a somewhat of a lower bound on this across nearly all countries. In particular, lower income countries saw more losses in 2020 and are expected to continue to see a gap between their actual activity and kind of what was expected for years to come. The good news is that the macroeconomic losses in rich countries have been much more limited than anyone thought they would be in April 2020, especially considering how much worse the news about the pandemic has been since then. I think there are just two lessons, basically. And I think, first of all, fight recessions with aggressive countercyclical fiscal policy if you as a country have the space to do it. It's not a magic bullet in the sense that some countries don't have that ability to borrow to fund this kind of spending. My second and last lesson is we need to build off these pandemic technologies. So remote work can make people and society better off in various ways. It can increase the match between workers and firms, which is good for wages and good for productivity. It offers avenues for firms to be more family friendly. It can potentially address shortages of affordable housing. It hopefully will reduce traffic congestion and pollution. I do worry about the inequities. We know that remote work opportunities are greater for higher earners, and we also know that they're greater for richer countries than poor countries. So I think the fear is that this might be another manifestation of technologies that benefit some people in some countries, particularly those in the knowledge economy and not others.
The IMF puts out this World Economic Outlook twice a year. And the nice thing about it is that they publish, say, the next 5 years projection. If I look at the IMF's projections for 2024, the US is 2.5% above where they thought it was going to be. So for the US, there is no gap. There's above trend in 2024. For Europe, they are barely 0.7% below where they thought it was going to be. For Latin America, it's more like 6% below. For Sub-Saharan Africa, it's 9% below. And for India, it's 15% below. The first conclusion I would like to say is let's come up with good ideas to prove the IMF wrong, that we don't want those projections. But if those projections are right, this is a humongous long-term shock. The net present value of this shock is huge. And now, if you try to decompose why did this happen, the first one is the difference in the fiscal response. There's a dramatic difference in the fiscal response. The US went way out in terms of fiscal expansion. Europe is expected to go significantly out in terms of fiscal expansion. But since not all countries in Europe had the capacity to do that fiscal expansion, they decided to coordinate a response at the European level, so that Europe was going to borrow as a whole and give money to those that would have had more trouble borrowing. And that's one of the reasons why Europe is expected to recover more quickly. In the developing world, what you saw is that the recession was deeper, that the recession had a very deep impact on revenues. So the increases in the deficits that you saw in the developing world were more driven by collapses in revenue and they had a much, much smaller response in terms of increasing expenditures. And that was one of the reasons why the short-term damage was so large.
So there's a recent study by McKinsey Research that has estimated that school kids across all age groups have lost on average about 4 to 5 months of their education during last year. So that's about half the school year. Now, these effects are there for elementary school kids and that are there for high school students. And there was no evidence that they actually have shrunk over the last year, which you might have thought because there was sort of more presence over last year than in the spring of 2020. And in fact, there's some evidence that they have even increased. McKinsey, comes up with numbers there. You take those with a grain of salt, but the magnitudes are staggering. So they estimate that this will reduce the economic pie, GDP, by around 150 billion per year as these generations start entering the labor force. And if you multiply this by 20, 30, 40 years, if those gaps are not closed over their working lives, you can easily end up with numbers that are of the order of 10 to 20% of annual GDP. There are proposals there to try to educate our kids during the next 2 summers, for example. That would, some studies suggest that could actually help close most of this gap. But that's a very timely problem that I think we need to face right now in order to sort of avert issues down the road. These effects are not equal across all kids and not across all schools. We have evidence that these effects are larger in public schools, especially in public schools in low-income communities, also larger for students with minority backgrounds. So I think that's something that, especially from that lens, and that we all want inclusive growth, well, that's the opportunity to actually deliver on that promise and actually help those students that have fallen back more now.
The way the question is typically posed in the US is, why has labor force participation declined so much? Unemployment rates are back to very low levels. And the question is, why are fewer people working now than before? In the part of the world where I work on, that's not the issue. The issue was that there was a massive destruction of formal jobs last year. And while GDP might be close to 2019 levels, maybe at the end of this year or so, unemployment rates are significantly higher than they were. I think that an additional issue is that you have a bunch of companies that survived the recession, but they survived the recession with severely damaged balance sheets. So if these economies recover, these companies might have a great future, but they have a bad balance sheet. So I think there's going to be, in many of these firms, an equity shortage. They're short of equity. And because they're short of equity, banks may not be that willing to lend money to them. These companies really need an equity injection more than a debt injection. And these equity instruments are not really there. So one of the ideas I have proposed is that we should create some instruments to inject some equity into these firms. And equity in this context would be a complement of debt, because then banks would be more willing to lend to them and so on. We should be thinking of maybe having, the IFC sponsor or SPAC, or, this special purpose acquisition company that would issue debt in advanced country stock markets to be invested in these kinds of firms that have a promising future but a bad balance sheet.
We are seeing these worker shortages very unusual for so soon after just a period of staggering job losses. And it's because people have dropped out of the workforce. We have a surprisingly limited understanding of what's going on. But the various things that I think we have some evidence for is ongoing fear of the virus. I think the numbers there are kind of bigger than a lot of people kind of expected, given so much of the population has been vaccinated. And I think we understand why now with breakthrough cases and the emergence of Omicron. The childcare, I think, is an issue. It is true that childcare centers are back up and running, but they're suffering from worker shortages too. So people, are having trouble getting their kids in, and that is like a chicken and the egg problem, and they can't go back and be in the workforce. So they're contributing to the worker shortage. People have kind of more financial resources in many of these countries because the fiscal response was so strong, leaving them with financial buffers. Older workers have been able to retire early, which is not a bad thing for them, even if it's a bad thing for the macro economy. But I think the really interesting questions are around kind of this great resignation or this period for younger workers who are staying out of the labor force. And I think there will be benefits for workers and ultimately for firms, because I think this is a disruption that is allowing us to do a collective rethinking of kind of norms around workers. And we're seeing it manifested partly as kind of higher wages for workers, but I think it's a more general rethinking about what workers want. I think it's about job ladders, about, the flexibility of work, about things like healthcare benefits.
During 2020, the only game in the international front was the IMF. It was the only institution that had the balance sheet to be effective. And the reason why the IMF had the balance sheet to be effective is because its balance sheet was massively expanded to deal with a European debt crisis. Let me put it in another way. When the issue was white people, there was a big appetite to increase its balance sheet. But the institutions that lend to brown people, call it the World Bank, the Inter-American Development Bank, the African Development Bank, they were not recapitalized. So when the crisis arose, the IMF put on the table $1 trillion. And the World Bank put on the table $10 billion, 1%, okay? And the IDB put on the table $3 billion. Irrelevant numbers. So I think that if we are going to rethink, so that we want to have international finance for people of different colors, I think we need to recapitalize these institutions.